Should you exit from equity mutual funds? Let's assume you want to accumulate rupees 25 lakhs for your daughter's marriage in the next 10 years by investing in equity mutual fund through SIP. There are two strategies you must follow while deciding the exit from equity mutual funds in the above case. Strategy number 1. You are driving on a highway in a fast lane towards your destination. When should you slow down and change lanes? First option, keep driving in the fast lane and take a sharp exit when the destination arrives. Second option, you should slow down a little earlier and move in slow lane before exit. The second option is better, as the first option is riskier and chances of accident are higher. Similarly, you should not stay invested till your daughter's marriage. You should start exiting through STP from equity fund to debt fund in the last couple of years. If you stay invested and market corrects, when you need the money, you will have to withdraw money in spite of loss, as your goal is due. Strategy 2. Due to lesser traffic, you were able to drive faster and reached your destination in 10 minutes earlier than expected. You must exit if the destination arrives earlier and should not keep driving for 10 more minutes. Similarly, while investing, if you get a better return than expected and reach your targeted amount of rupees 25 lakhs earlier, you must exit and should not stay invested. Remember, investment is a journey, not a destination. To know more about suitable products for your investment journey, contact us now. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.